Hello students, Dr. Wang is here recording. In this episode, I'm going to teach you how to do capital budgeting and how to do the risk control related with the capital budgeting. So right here, you have a company who produced fresh water and they are considering a project which costs equipment of $1.25 million and this project lasts for 5 years. And you also get the information for fixed cost and the variable cost, as well as the price per unit, which grows at 8% every year. You also have a salvage value estimated and depreciation method listed, and also tax rate and required return. What you need to do here is to first get a capital budgeting table, and you want to calculate the NPV of the project, regular payback period, and internal rate of return. You then need to conduct a scenario analysis. So you have 3 different scenarios. The expected case is a scenario listed above. You also have the best case where you have a highest price and lowest cost. And you also have the worst case where you have a lowest price and highest cost. All right, and they each come with certain probabilities. Your job here is to calculate the expected return from the 3 NPVs and also get the standard deviation based on the 3 NPVs. And then you're going to create a chart for it. Number 3, you're going to conduct a sensitivity analysis. So you will do the analysis for cost equipment and also for water price, all right, or the price per unit. And you're going to get the different NPVs when the variable change by different percentage. So you will have 7 NPVs for each variable or 7 percentage changes from a 30% and 20% all the way to a negative 20 and 30%. When you have the Excel, that's going to be very easy. So the first thing you're going to do is to list all the information mentioned in the context. So the first number we come across with is cost equipment. So let me just put in there. And that is $1.25 million. Okay, $1.25 million. Put in dollar figure. And you also have a life in years. So how many years does it exist? It's 5. And you also have the fixed cost, and that is $140,000. And you also have units production, okay, units, and that is 200,000. Okay, and this number I want it to be comma. All right. And the next information here is price per unit. So that's $4. Okay, just be consistent with the format. And then you also have growth rate. Okay, price growth. That is 8%. And you also have variable cost or cost per unit. That is $1.4. All right, and then you also have a salvage value, and that is 600,000. So it basically means after 5 years, you're gonna sell the machine, and then you're gonna get $600,000. All right, and then you have a tax rate that is 40%. You have a required rate of return. That is 9%. All right, so that's the numeric information available in the context. So after I extract all the information, I just did it here, and then I'm going to construct my capital budgeting table. So I have different years, first of all. I have a year 0, I have a year 1, okay, year 0, 1, 2, 3, 4, 5, right? I'm going to leave it right here. So that's the 5 years of data. And for cost of equipment, it occurs on the first year. Okay, and it will be a negative number. All right, so that's a negative $1.25 million. And then I need to calculate the operating cash flow, which occurs on an annual basis. So to do that, I need to get the price for each year. So the price is $4 to start with, and then it will grow by 1 plus this 8%. Okay, I need to lock that 8% by putting $sign or just hit hotkey F4. All right, so you see the next year, the price will be the previous price times 1 plus 8%. Right, so this is in dollar, and then drag it all the way. Okay, and the unit here is always at 200,000. So I just put a 200,000 and then lock it before I drag it all the way. So based on price in units, I can get my sales. So that is price times units. Okay, these are also in dollar figure, decrease decimal. All right, and then I have a variable cost. Okay. The variable cost here is units, okay, times the cost per unit, okay, and I need to log that cost per unit before I do the dragging. So it's always 280,000. Okay, then drag it. And the fixed cost, it is 240,000, and log it. Drag it all the way. And then you can get EBIT, which is sales minus variable cost minus depreciation. Right? Not yet. Okay, I need to insert another row. Okay, it's called depreciation. All right, now this is the challenging part. How do you get a depreciation? Your depreciation method is MACRS, and you're gonna check the table designed by the IRS. You're gonna find the assets type. This asset is a 5-year asset, so you're gonna need the number in this column. This is for 5-year assets. 3 years is for beverages and food equipment. 5 years is more like office supplies and short-term products, machines. And then you have a real estate and also vehicles assets that would last for 7 or 10 years. Anyways, so you're gonna pick the numbers from the MACRS table. So what I would like to do is put a MACRS right here, and I put a year 1, 2, 3, 4, 5. Okay, and then for the first year is 20%. The second year is 32%. Okay, the third year is 19.2%. The next year is 11.52%. The fifth year is the same, 11.52%. Okay, you see I did not put this 5.76% because it is the remaining value of the machine on the book after 5 years depreciation. All right, so if I try to get the depreciation, I will use the cost equipment. Okay, lock it. Make sure you lock it. Okay, put F4 or just put a $sign and then multiply by a percentage. All right, and then you drag it all the way to the right. You will see that each time I keep using the cost equipment, multiply by the percentage. Right, so that's my depreciation. And then you can get the ending book value based on the depreciation of all the 5 years. It is this total value minus the sum of all the depreciation. All right, so that's your ending book value. Okay, so now let's get my EBIT. So my EBIT is sales minus variable cost minus fixed cost minus depreciation. All right, now we're talking, and this is the EBIT for all the 5 years. All right, and then you need to pay taxes. There's no interest, so you just directly go to taxes. So the tax you pay is based on the numbers here. So EBIT times the 40% tax rate, and make sure the tax rate is locked. All right, and then drag it all the way. So you actually earn some tax credit, and you can carry it forward in the following years. So right here, you're not paying tax, instead you're getting tax credit. And then you have net income. And net income is EBIT minus taxes. All right, and then drag it all the way. Okay, and then you're gonna get the operating cash flow, which is your net income plus depreciation. Well, you deduct depreciation at first, now it's time to add it back. Okay. So these are your operating cash flow for each year. All right, so now you have a cost equipment solved and operating cash flow solved. And you should have a change of net working capital, but right here, for a water producing business, you don't really need to keep any inventory. So we can skip that part. It's not even mentioned in the context either. So we just get to the salvage cash flow. Salvage cash flow. So what you see here is at the end of the period, you're going to sell the machine for its salvage value. So certainly you're going to get this part, 600,000. Well, that's a lot of money you can sell your machine at, right? And also you need to pay taxes on the capital gain. So you need to pay taxes, so minus 40% of the capital gain. So what is capital gain? The capital gain is the money you get for selling the machine over or in excess to the ending book value. All right, so because on the book, you report to the IRS saying that my machine is only worth $72,000 when I sell it, but actually I'm going to sell it for $600,000, way above it. So I need to pay taxes on the difference, and that difference is called a capital gain. So with that being said, this is your salvage cash flow, which the company expects to receive at the very end when the machine is liquidated. All right, and then you put a dollar sign here. Okay, so you have a 3 component. You have a cost equipment, you have an operating cash flow, and you have a salvage cash flow. So these 3 components will make the free cash flow. All right, so the last one is a free cash flow. So free means it is free from a financial cost. You're gonna add the components here. So it is the cost equipment for the first year, and then it is operating cash flow for the rest of 4 years, and for the 5th year, you're gonna add the salvage cash flow. Okay, you're gonna add the salvage cash flow. All right, so now you have finished your capital budgeting table.